Stocks are under pressure ahead of the closing bell as the markets brace for NVIDIA earnings on Wednesday. And joining us now is Simeon Hyman, global investment strategist at ProShares. Simeon, it is always good to see you. Maybe just off what Julie was just talking about there, Simeon, something interesting you said, which is that investors seem to be now perhaps questioning whether there's a change in market leadership taking place here. What do you mean by that, Simeon?
Look, the good news is that tech stocks aren't falling through the floor. They're not leading, but they're not falling through the floor. So we're not in a position of suggesting that this is back to where we were in 1999. There's good stuff here. There's tremendous cash flow generation in the S&P 500, driven by that cash flow generation, has very low levels of debt. But things are changing at the top of the house, as you noted. Tech is almost at the bottom of the house in terms of performance so far year to date.
So how do we know if this is, sort of, sometimes we get this at the beginning of the year, right? You get sort of the scramble, scrambling up of the best performers from last year that then fall behind. How do we know if this is a sustained change in leadership? Do we just have to wait to find out, or what do you think?
I think you have to combine what the market's telling you with the fundamentals. And it's why, and look, it's tough to be the broken clock right twice a day. We always talk about dividends at ProShares, but dividend, and particularly growth and dividend growth, is on sale. And it's on sale in a way that it hasn't been in a long time. But even though the price has lagged, the fundamentals haven't. The S&P 500 Dividend Aristocrats, it's our ETF ticker, NOBL. You've got double the dividend yield. The dividends grow faster than the S&P 500, but the return on capital is 50% greater than the S&P 500. So I think you don't just want to shop in the bargain bin, you want to shop for quality on sale. And that's where you can get some sustained new leadership over the course of the next few quarters.
I have a separate question, Simeon, just as a long-time market watcher. I'm just curious to get your thoughts. When you hear that Warren Buffett, greatest value investor of all time, and you heard, Simeon, the kind of cash pile he's now sitting on, it's basically the market cap of Coca-Cola. When you hear the Oracle would rather sit on that than put that to work, what, as a long-time market watcher, what is that telling you as an investor?
It is tough to pay over 30 times for the companies that are having some of the greatest earnings growth. Q4 earnings were still very, very strong for technology, but it's tough to put that at work at 30 times. But there are opportunities. As an example, IBM is a S&P 500 Dividend Aristocrat. It's up 20% year to date, on the back of saying their AI business is good. So there may not be nothing wrong with the fundamental thesis. It just may be that those Mag 7 stocks got a little bit too expensive. And look, those of us who aren't great market timers, you can't sit on cash forever. We all know the numbers. You miss a couple of the biggest days and you're out forever. And by the way, if you're looking to manage risk, we would suggest don't stay out of stocks. Just make sure you have your balanced portfolio again, because we don't have zero yields on the 10-year Treasury. Look what's happening right now. The 10-year has rallied. So the ability for bonds to diversify stocks are back, and that's the prudent way for most people to manage risk, not staying in a money market fund.
Well, and you are the latest in a parade of folks lately who has said you need to be more diversified right now than you have been. It's not good enough to just buy the Mag 7 and forget it at this point. So what does that diversification look like? Do you buy, say, the S&P equal weight? Do you go down in size? Because small caps have not been doing much for you if that's what the way that you have gone.
You can't stop at just adjusting your large cap portfolio in an equal weight sense. If you go back to the early aughts after the tech bubble burst, equal weight helped you, but you know what helped the most? Mid caps. Why use a blunt instrument of just equal weighting the S&P 500 when you can just have mid caps?
And everybody kind of forgets about mid caps.
It's the highest performing segment of equities over the last several decades. They're 50 cents on the dollar to large. And if you want a little extra opportunity there, the dividend growers and mid caps are on sale even cheaper than the S&P 400 themselves. The S&P 400 Dividend Aristocrats, RETF ticker REGL, it's a very cool way to get mid cap exposure.
Simeon, do you want to stay U.S. focused, or do you see any opportunities overseas? I guess today, for example, Chinese names. Some of them are really getting batted around, but some of those names have enjoyed nice recent runs, Simeon.
On the domestic front, there is an opportunity, particularly in mid-caps, to be a little bit sheltered from the tariff story. So mid-caps as a whole have 75% of their revenue sourced domestically, as opposed to about 50-50 in the S&P 500. And that makes a lot of sense to us, have a little bit of defense there. But I'm an investment policy statement guy. That means you don't zero out big parts of the market, and particularly developed international markets are still 20-25% of the equity land. So even if you want to be patient there, you still got to have 10 or 15% in your portfolio.
Simeon, good to see you. Thanks for coming in.
Thanks for having me.